If you take $50 million in silver in from the public in various forms, from flatware to shot to doré to whatever it is, and you have to break it down. Like if you get a knife in flatware, the blade is stainless steel, the handle is made of plaster, and there's a thin layer of what's it called, sterling silver over the. So you got to break off the handle. You got to pull. It's labor intensive. By the time you're even melting it down to turn it into shot, which are little BBs, to melt that down to make the mold for your bars. During January, in December and January, the price was moving up so fast. So if they have 50 million in, they sell 50 million on COMEX, so they're market neutral. The price was moving up so fast that they were getting margin calls on their short position. And then add on to it the increase in margin requirements. They're like, we can't take any more business. We're going to go out of business. We're getting margin called. We're exposed to this volatility. So let's just hold off. So between that and the massive load, it created a consequence that has yet to even begin to work its way out. So we're still way back on refining capability, capacity, and time frame. So it hasn't worked itself out yet. When the most well-informed traders in the world show you this through removal of counterparty risk, it's real. And the other side of that coin is that when the people who print the money are buying the one asset that cannot be printed, the central banks now own nearly 20% of all of the gold in the world, and they now hold more gold than U.S. Treasuries for the first time ever in their foreign reserves. That should tell you everything, that the deepest pockets in the world are moving out of paper and into hard assets because they see what is coming. And that's the most important thing. They use misdirection of price, of narrative, of media coverage, of everything to quietly fill their own pockets. And they're the ones that are printing the paper. They're the ones who want to keep us in the system, right? But their accumulation and repossession of it, or taking it away from the two places that were for forever been used as the center of liquidity and trade and commodities.
What if I told you the silver market isn't just tight, it's structurally broken? Behind the scenes, refiners are overwhelmed, traders are getting margin called, and the biggest players in the world are quietly ditching paper promises for real, physical metal. And here's the kicker. While prices look normal on the surface, something massive is building underneath. Let's break it down.
And repatriating it back home, even at the expense of convenience, prioritizing lack of counterparty risk, or removal of counterparty risk, rather, that should tell you all you need to know. And these are the big macro things that you have to look at and say, I get it, because it pulls on your emotions when the counterintuitive nature of the times that we find ourselves in and the price doesn't move the way we think. I think price is the greatest tool of misdirection. And that is why the whole price setting mechanism scheme centered around shorting it in New York, which pushed the paper price down, and then going long in London to offset the liability on their balance sheet, where it didn't affect the price. Now, it never came back. They would just go back and forth with warrants to keep the price down. Now we're seeing, you know what? I don't want the warrant. I don't want the paper. I want the actual metal. Send it to me. That's happening here. The rest of the world, I think, in the global south, has been using the fact that we suppress the price to quietly stand for delivery everywhere else, where price is not defined or affected by pulling metal off everywhere else. It's only affected in New York. That's where it's set. So if the paper gets smashed here, they can be fine. Thank you. We'll stand for delivery here, 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 and here, quietly, without the coverage of the media, and it won't affect the price. So these things are starting to accelerate when you see removal from the exchanges and really low open interest on COMEX. You're getting an environment where people say, this is not the sandbox I want to play in anymore because it's rigged. So the ones taking an inordinate amount of risk in an environment where premiums can change, you can't hedge your premiums. We were the ones that were paying $13, $14 over spot for Silver Eagles for 4 years. The ones that were paying $9 and $10 over spot for junk silver for 4 years during the pandemic. We lost hundreds of thousands of dollars at the end of 2023, hundreds of thousands, bordering on seven figures, when the U.S. Mint and I had almost 100,000 Silver Eagles in stock that I paid $9 over spot for. And just like that, the U.S. Mint, after 4 years of being the model of inefficiency and getting bombarded by the market, saying, why is it easier to buy silver kangaroos from Australia than it is eagles? what the heck's going on. The law says you have to print as many or make as many as is demanded by the public. Miraculously issue 4 million Silver Eagles, and I lost $5.50 an ounce on almost 100,000 coins just on the Eagles. Everything. I mean, the point of it is that what business is here to do things for free? What asset can you buy where you don't pay a bid and ask spread? There's risk, there's costs, insurance, shipping. Everything is getting higher and higher and higher, as is the risk.
Sorry to interrupt, but if I buy from you with the intent of selling back to you at some point in the future, I want you to be in business in the future when I need to sell back to you. Right? Well, like you have to be able to run your business without going out of business.
That's the point. And I think most people, look, everyone has different priorities and agendas. For me, when I buy gold and silver, I'm hoping I never need to sell it. Now, I'm not saying people need to do this. I'm just saying I hope to give it to my children someday. It's there if you need it. There are, if you're looking at a short-term in and out to capitalize on price, there are more convenient ways to do this. Now, I will say this, and I really need to be careful with this because I've talked with you a little bit about this. I'm working with some people to address a lot of those concerns, to find less friction, to find a way to collateralize, to find things that inspire confidence and trust. The industry is moving this way. Let's just say digital forms of gold that are redeemable down to 1 ounce, and everything from soup to nuts in terms of who's storing it, who's auditing it, is it deliverable, what is the cost of storage, oh really, what is the cost of purchasing, are you kidding me? Those kinds of like, whoa, it's coming, right? It's coming. And it's coming across. There's many groups that are trying to perfect this. These things will be addressed, but I will simply say to you this, that from a standpoint, when I tell people that I know that own businesses, how much money we make on a percentage basis, doing almost over 900 million in sales, and you only made that? Are you kidding me? Really?
Very low margin business.
It's very low margin and a lot of risk, especially over the last few years, where premiums have literally become schizophrenic. So, I get the point. And a lot of the things that people are saying are based just upon if I sat down with that person and we sat down and had a beer and I could tell him and be completely transparent, that person would change what they're saying in 1 second. Oh, I get it now. So yes, there is bid and ask in everything you do. And I think lately what has happened with premiums accentuates his point, but it's not controlled by us. It's controlled above us. The primary mint distributors are the ones that control that. And when you have the CME Group come in and jack up margins by 300%, so in December, it cost me roughly $15,000 to hedge 5,000 ounces of silver. And we have normally 2 million ounces or more in our warehouse. You gotta have a lot of money in a margin account. Within 2 months, month and a half, it was $54,000. Yeah. So think about that from a hedging standpoint. That's just silver. What about gold? What about platinum? There are a lot of things that go into this to be able to be here to provide the service. It's not as easy as just, setting up shop and saying, well, here we go. You want to protect your inventory, run a good business, pay for insurance, which keeps on going higher, everything. There's a lot involved, but I will tell you that I've never seen premiums like this in my career, and I think it's an anomaly, and it'll go back to where it was. You get big participation in this industry from the public, even just a 10% increase, and all of a sudden you'll see premiums shoot the other way, and then it changes.
It starts with a problem most investors never think about. Refining silver is slow, complex, and labor-intensive. When scrap silver comes in, whether it's flatware, jewelry, or industrial material, it has to be broken down piece by piece, separated, melted, and recast. That takes time. Now imagine this happening while silver prices are exploding higher. Refiners hedge their inventory by shorting futures on exchanges like the COMEX. But when prices rise too fast, those short positions trigger margin calls. Then add another layer, rising margin requirements from institutions like the CME Group. Suddenly, refiners are trapped. They can't process fast enough. They're getting hit with margin calls, and many are forced to stop taking new business entirely. That's created a massive backlog in physical silver supply, and it still hasn't been resolved. Now zoom out to the bigger picture. The smartest money in the world, central banks, are doing something very telling. They're accumulating gold aggressively and reducing exposure to paper assets. Why? Because they see the risk of counterparty failure, the risk that paper promises may not be honored. And that's exactly what's happening in the metals market. For decades, prices have been largely set in paper markets, futures trading in New York, often disconnected from real physical demand. But now the game is changing. Instead of rolling contracts forward, more players, especially across the global south, are saying, "Forget the paper, send us the metal." That shift is huge, because every time someone takes physical delivery, it drains supply from the system, while the paper price barely reflects it. At the same time, silver faces a unique problem. Unlike gold, most silver is consumed, not stored. It's used in electronics, solar panels, and medical tech, often in tiny amounts that are never recycled. So over time, it simply disappears into landfills. Meanwhile, mining supply is tightening and above-ground reserves are shrinking. All of this creates a dangerous imbalance. A paper market controlling price, and a physical market running out of supply. That's the disconnect few investors truly understand.
If you take $50 million in silver in from the public in various forms, from flatware to shot to doré to whatever it is, and you have to break it down. Like if you get a knife in flatware, the blade is stainless steel, the handle is made of plaster, and there's a thin layer of sterling silver over the, so you got to break off the handle, you got to pull. It's labor intensive. By the time you're even melting it down to turn it into shot, which are little BBs, to melt that down to make the mold for your bars, during January, in December and January, the price was moving up so fast. So if they have 50 million in, they sell 50 million on COMEX, so they're market neutral. The price was moving up so fast that they were getting margin calls on their short position. And then add on to it the increase in margin requirements. They're like, we can't take any more business. We're going to go out of business. We're getting margin called. We're exposed to this volatility. So let's just hold off. So between that and the massive load, it created a consequence that has yet to even begin to work its way out. So we're still way back on refining capability or capacity and time frame. So it hasn't worked itself out yet. I don't know anyone my age who has any. It's usually their mom or the grandma that has it or passes it down. You know, I look at it, maybe the people way back when who were using silver really knew what the hell was going on. Born with the silver spoon in your mouth, the antimicrobial, yes. Their silver is used in medical devices, it's woven into the sheets of hospitals because of its antibacterial properties. I think a lot of it had to do with they didn't have the technology of food safety and purification, all that stuff back then. So the wealthy would use silver. I would argue silver cups,
silver helped,
silver forks for health. That's right. But you're right. No one really has it any longer. And you know what?
But there's still a lot, right? I mean, it's still a pretty annual flow to these things, right? But at some point, that's going to trickle out, right?
Absolutely. And those that have it, if you use it once a year for Thanksgiving or something, twice a year, it's a lot. Most people don't know what to do with it. But yes, it is something that probably like silver dimes and quarters that over time just work their way out of circulation. Same thing here. I mean, I think that those that would sell it will sell it or it will be passed down, but not something we see that often any longer. It was more so years past. To your point, it just seems as though it's not really prevalent anymore. I think a lot of that silver came out of the woodworks between 50 and 100. I do. You would think that those that wanted to sell it probably did the minute we got up into 60 and 70, thinking it would never happen. And you're right, silver is what's called inelastic, meaning there's a tiny bit in a bigger piece. You know, I don't know how much silver is in an iPhone, $5, $6, $7 worth, right? But you need it to make it work.
But you're not going to send your iPhone to the refiner, right?
Right. Now, if there was the same amount in ounces of gold in there, maybe you would. But silver, there's just not enough to make it economical, never has been. And that's another point. If you think go backwards from there, anything that's conducted electricity or electronics, even a simple light switch. Now, some of it's copper, but majority has silver in the circuitry. Go back to the time you were a kid, and anything you touched that was electronic or electric or conducted electricity, chances are there's a little bit of silver in it, and all that stuff is in landfills. So all of that stuff is gone, and that's why you're seeing a silver that was so abundant for so many years. Keith Neumeyer will tell you it's coming out of the ground at 7-to-1 now. Relationship to gold, it was 16-to-1 before. So not only is it disappearing in nature geologically, but above ground, because it is used in such tiny amounts in things that need it, where it doesn't pay to recycle it, gets thrown in landfills, it's gone forever. So I would agree with you very much so on that, unless it's a big amount of silver. Like, for example, solar panels get recycled. I would assume that these new solid state batteries that Samsung is making with a kilo of silver in it, those would get recycled. That would be worth it. But most electric things have such minute amounts, it doesn't pay. You pay more an hourly rate for someone to do it than you would get on the take.
So here's the bottom line. This isn't just about price. It's about trust in the system itself. When the biggest players in the world move from paper to physical, when supply chains start breaking down, and when demand quietly drains inventories, that's when markets don't just move, they reprice. The question is, will you see it coming before everyone else does? If you found this breakdown valuable, make sure to subscribe, and stay ahead of the curve, because the next phase of this metals market could catch a lot of people off guard.